Open almost any standard economics textbook, and you will find a neat, comforting picture of how money supposedly works. It shows a pyramid. At the very top sits the Federal Reserve, the all-powerful controller of money. Beneath it are the commercial banks, J.P. Morgan, Citi, Bank of America. And at the bottom lies the real economy, factories, small shops, salaries, and the wallets of ordinary people. According to this story, the Federal Reserve controls the supply of money by adjusting base money at the top of the pyramid. When the Fed prints, the money supply expands. When the Fed tightens, the money supply contracts. It looks clean, mechanical, and well managed. It suggests there is a pilot in the cockpit, steering the global economy with steady hands. But this map is wrong. It leaves out an entire continent of money. Hidden behind the official system is a second pyramid, a shadow structure that exists mostly outside the United States, beyond the reach of the Federal Reserve, and largely beyond the understanding of the politicians who claim to govern the world. This is the Eurodollar system. Despite the name, it has nothing to do with the euro currency. The term is just a historical accident. A Eurodollar is simply a US dollar held in a bank outside the United States. According to the Bank for International Settlements, the so-called central bank of central banks, the true size of this offshore system is almost impossible to measure. But conservative estimates place the derivatives and liabilities connected to it at more than $80 trillion. To understand how massive that is, compare it with America's official money supply. The M2 measure, all the dollars inside the U.S. banking system, is around $21 trillion. That means the offshore dollar system is roughly 4 times larger than the real domestic dollar system. This is not a tail wagging the dog. The tail has become a dragon. The global financial system does not primarily run on dollars printed in Washington. It runs on digital ghost dollars created on the balance sheets of banks in London, Tokyo, Singapore, and the Cayman Islands. These banks create dollar claims without holding real dollars in their vaults. They multiply credit on top of a tiny base of actual cash, turning $1 into $20, $30, sometimes $50 of lending power. This vast machine was not designed by Wall Street strategists. It was born from Cold War fear. In the 1950s, the Soviet Union earned dollars by selling oil and raw materials to the West, but Soviet officials were terrified of keeping those dollars inside American banks. They understood that if political tensions escalated, the U.S. government could freeze their accounts overnight. History proved that fear justified decades later. So instead, the Soviets moved their dollars to London. They deposited them in the Moscow Narodny Bank, a Soviet-owned institution operating under a British banking license. Their request was simple: hold our dollars, but keep them outside American legal control. British bankers, eager to restore London's fading financial dominance after World War II, agreed. Those dollars stayed on British balance sheets, recorded in London, not New York. And so the Eurodollar was born. This created a strange legal loophole. A dollar inside the United States must obey Federal Reserve rules. Banks must hold reserves against it. They must pay insurance fees. Their lending is regulated and limited. But a dollar sitting in London? To the Bank of England, it was just a foreign currency deposit. To the Federal Reserve, it was outside American territory. It existed in a regulatory vacuum. Banks quickly realized what this meant. With no reserve requirements, lending limits, or meaningful oversight, they could expand credit almost without restriction. If a bank in London received a $1 million deposit, it could lend that same $1 million to a company in France. That French company would deposit the money in Paris. The Paris bank would lend it to a firm in Italy. On paper, the original $1 million became $3 million in Eurodollar deposits, but in reality, only $1 million of actual cash existed. The multiplier had no ceiling. This vast machine became a high-speed credit factory, operating far faster than the tightly regulated U.S. banking system ever could.
By the 1960s and 1970s, it exploded in size. It became the engine of globalization. When a Japanese company buys oil from Saudi Arabia, it does not pay in yen, it pays in US dollars. But those dollars usually do not travel through New York. They move through offshore banks in London, Singapore, or Hong Kong. The Eurodollar became the lubricant of world trade. It allowed commerce to grow far beyond what US gold reserves or domestic money creation could support. It financed container ships, factories, highways, and megacities. It quietly underwrote the economic boom of the late 20th century. But it carried a fatal weakness. Unlike the US system, it had no central bank. Inside America, when a bank runs short of cash, it can borrow from the Federal Reserve. The Fed acts as lender of last resort, preventing total collapse. In the Eurodollar world, there is no such safety net. If banks in London and Tokyo stop trusting each other, if they stop rolling over loans, the system doesn't bend, it snaps. This creates a paradox, a shortage of dollars in a world supposedly drowning in them. The reason is simple. Most Eurodollars are not money. They are promises. They are short-term debts that must be renewed constantly. Every day, billions of dollars in loans mature and must be replaced with new loans. If fear enters the system, if banks start hoarding cash, borrowers can't refinance. They scramble for real dollars to settle their obligations, but there are never enough real dollars. That scramble sends the value of the US dollar soaring. Emerging market currencies collapse, trade financing dries up, cargo ships stop moving. This is not theory. It is exactly what happened in 2008. That crisis was not merely about American housing loans. It was a global run on the Eurodollar system. European banks had borrowed trillions in short-term offshore dollars to buy U.S. mortgage securities. When those securities failed, lenders refused to renew the loans. European banks were suddenly insolvent, and they needed dollars, not euros. So the Federal Reserve stepped in. Quietly, without public debate, it opened massive dollar swap lines to foreign central banks. It printed dollars to rescue overseas institutions. In that moment, the Federal Reserve became the central bank of the world. And the truth became impossible to ignore. The Federal Reserve controls only the head of the dollar system. The body lives offshore.
The modern dollar system is a strange creature. The Federal Reserve can raise interest rates in Washington, but if offshore banks in the Cayman Islands or Hong Kong decide to expand credit, global liquidity increases anyway. And if those same banks become fearful and contract their balance sheets, the world economy suffocates, regardless of what the Fed wants. In practice, monetary policy is not set by a committee in Washington. It is set by risk managers in private banks. What you call money in your bank account is often not a real dollar at all. It is a Eurodollar, a promise issued by a bank that is leveraged 30-to-1 in a lightly regulated jurisdiction. This system only functions as long as trust holds, and trust is fragile. The deeper danger lies in the direction of the system. In everyday life, we think of money as an asset. You hold a dollar, you own a dollar. In the Eurodollar world, almost every dollar is a liability. It exists because someone borrowed it. When a Brazilian company borrows $100 million from a London bank to build a factory, it is effectively short the dollar. It has promised to deliver dollars in the future that it does not currently possess. Multiply that behavior across the planet. The result is an $80 trillion global short position against the U.S. currency. As long as growth is strong and the dollar is cheap, this works. Companies earn local currency, convert it into affordable dollars, and service their debts. But when the dollar rises, everything changes. When the Federal Reserve raised interest rates in 2022 and 2023, it triggered a worldwide margin call. Suddenly, foreign borrowers needed far more of their local currency to buy the same number of dollars. Their debt burdens exploded overnight. They panicked. They rushed to sell their own currencies and buy dollars before the situation worsened. But that buying pressure pushed the dollar even higher, which forced the next borrower to panic, and then the next. A self-feeding spiral began, a doom loop where the act of protecting oneself made the system more dangerous for everyone else. This is why the dollar behaves strangely in crises. Instead of collapsing, it surges. Everyone complains about the dollar, but everyone needs it to survive. This dynamic is known as the dollar milkshake theory, popularized by macro-strategist Brent Johnson. Picture the world economy as a giant milkshake. The milk is global capital, savings, investments, liquidity. The United States holds the biggest straw. When the Fed tightens policy, it sucks liquidity not only from New York, but from Tokyo, Frankfurt, Sao Paulo, and Mumbai. Money flees fragile economies and floods into American assets. That is why U.S. stock markets can reach record highs while Europe stagnates and China slows. It is not strength, it is gravity. The Eurodollar system constantly pulls wealth toward the center. Foreign central banks print their own currencies to buy dollars, exporting inflation at home while sending capital abroad. The United States imports wealth, the rest of the world imports rising prices. Yet this machine depends on one critical ingredient: collateral. Banks do not lend trillions of dollars based on trust alone. They demand security. And the best security on earth is U.S. government debt. Treasury bonds are the sacred collateral of the shadow banking system. They are the poker chips of global finance. If you want to borrow dollars overnight in the repo market, you must post treasuries. This creates an enormous structural demand for U.S. debt.